Hello and welcome to the Smart Wealth channel. Today we discuss active and passive investing, their pros and cons, and what is the difference between these two concepts. We're sure that you're ready to watch the video, but before that, subscribe to our channel and click on the bell to be notified when a new video is released. So, let's start. Active investing means investing in funds whose portfolio managers select investments based on an independent assessment of their worth, essentially trying to choose the most attractive investments. Generally speaking, the goal of active managers is to beat the market or outperform certain standard benchmarks. For example, if you're an active U.S. equity investor, your goal may be to achieve better returns than the S&P 500 or Russell 3000. As opposed to active investment is a passive investment. If you're a passive investor, you wouldn't undergo the process of assessing the virtue of any specific investment. Your goal would be to match the performance of certain market indexes rather than trying to outperform them. Passive managers simply seek to own all the stocks in a given market index in the proportion that they are held in that index. Because active investing is generally more expensive, you need to pay research analysts and portfolio managers as well as additional costs due to more frequent trading. Many active managers fail to beat the index after accounting for expenses. Consequently, passive investing often has outperformed active because of its lower fees. Of course, both ways of investing have pros and cons, so let's take a look. The pros and cons of active funds. Active funds can generate higher returns than a pre-selected benchmark. Fund managers can choose to increase or decrease the amount invested in each stock, or release specific holdings or market sectors when risks get too high. Thus, active funds are flexible and have better risk management. On the downside, the decision-making process is prone to human error. There's no guarantee that they will generate higher returns or be entirely risk-free. When investing in active funds, you also have to pay a fee known as the expense ratio for the fund manager's expertise and decision-making. Thus, active funds are more expensive. The pros and cons of passive funds. Passive funds have minimal fees because investors need not pay for a market analyst's expertise. As per SEBI regulations, the expense ratio for ETFs can be at most 1%, so they're less expensive than active funds. However, they always generate moderate returns. The returns may be less than or equal to the benchmark's returns, but never higher. Can you conclude from all that has been said now what are the differences between active and passive investment? Let's talk about it together. One of the foremost issues encountered while constructing investment portfolios is the strategy to be used while choosing investments, whether to use active investing or passive investing. Active investing involves being more aggressive in investment approach and hence would entail higher returns compared to passive investing. While it may seem more logical to go for active investing, there are merits in passive investing as evidenced by the growing popularity of the latter strategy over the past decade. Under active investing, investments are selected based on independent assessment of the value of individual investments, and an investor is always on the lookout for short-term price fluctuations. It involves extensive fundamental and/or technical analysis, and micro and macroeconomic factors influencing the investment are closely monitored. The objective of active investing is in outperforming the market. At the end of the spectrum, you will find hedge funds that embark on very aggressive investing involving high levels of leverage and focus on absolute returns rather than following the benchmark performance. This involves high risk since there is always the possibility that the investor/fund manager's viewpoint will not materialize. You need to be very good at picking up the right stocks at the right time. Also, this takes up considerable time to track the best investments and a high level of expertise and a risk-taking attitude. Passive investing is a more balanced investment approach aimed at matching the broad market performance. Passive investing has long-term focus and ignores short-term market ups and downs. A passive investor limits the buying and selling activities in his portfolio in response to changing composition in the tracked index to be matched. This is thus a more cost-effective way to invest and avoid short-term temptations or setbacks in price. A good example of passive investing is buying an index fund wherein the fund manager switches holdings based on changing composition of the index being tracked by the fund. The fund strives to match the index return rather than focusing on absolute returns. So which investment do you prefer, active or passive? Why? Please tell us in the comments. At the very end, make sure to like and subscribe to our channel if you haven't already. Press the notification button to never miss more videos like this. Hope you enjoyed today's video. Have a nice day, and see you again soon.